Everyone always says if you want to get rich, you need to make your money work for you. Fine, but nobody actually tells you where to put your money, what accounts you need, what accounts help you build credit, and what accounts can help you get approved for better cars, better homes, better funding, and better opportunities. That is why you follow me. My name is Marcus, and on this channel, I teach you how credit really works, how to improve your score, and how to stop letting bad credit cost you money. And in today's video, I'm going to break down the 6 most important accounts you need if you want to build wealth, build credit, and stop getting punished by banks. And make sure you stick around to the end, because I'm going to show you the one account most people ignore that can help you separate your personal credit from business funding. For every single account, I'm going to explain what it is, why you need it, how to use it, how it can help you, and the biggest mistakes to avoid. Because listen, getting rich is not just about making more money. It is also about not losing money to bad credit, high interest, bad approvals, and dumb financial decisions. Account number 1, a high yield savings account. What is it? It is a savings account that helps your money make more money while you are doing absolutely nothing, while you are sleeping, while you are at work, while you are driving, while you are sitting at home thinking about all the bills you forgot were due. Your money is still earning interest. Now, why do you need one? Simple, because part of getting rich is not going broke every time life happens. A flat tire should not destroy your budget. A medical bill should not send you into collections. A missed paycheck should not force you to swipe a credit card you cannot pay back. This is where a lot of people mess up. They don't have emergency savings, so when something happens, they use credit cards, payday loans, personal loans, or they start missing payments. Then one missed payment turns into a late payment. That late payment hits the credit report. Then the score drops. Then the next car loan comes back with a higher rate. Then the next credit card gets denied. Then the next apartment wants a bigger deposit. And now one emergency became a credit problem. That is why a high-yield savings account is not just a savings account. It is protection. It protects your credit. It protects your approvals. It protects you from needing bad debt when life gets expensive. How do you use it? Open the account. Set up automatic deposits. Every time you get paid, send money there first, even if it is $25, even if it is $50, even if it is $100. The first goal is $1,000, then 1 month of expenses, then 3 to 6 months of expenses. Do not overthink it. Just build the buffer. Because when you have savings, you do not panic every time something happens. And when you do not panic, you make better decisions. Now, mistakes to avoid. Do not use your emergency fund for things that are not emergencies. New shoes are not an emergency. A concert is not an emergency. A weekend trip is not an emergency. A sale at the mall is not an emergency. An emergency is something you did not plan for that can hurt your life, your income, your housing, your health, or your credit. This account is not there to make you feel rich. It is there to stop you from going broke. And if your credit is already damaged because you had emergencies and missed payments, then this is where credit repair comes in. You need to review your credit report. If you have collections, charge-offs, late payments, or old accounts that are reporting wrong, you need to get those reviewed. If something is inaccurate, outdated, duplicated, unverifiable, or not yours, you may be able to dispute it. Because the goal is not just saving money. The goal is protecting your whole financial profile. Account number 2, a credit card. Ideally, a rewards credit card. But if your credit is bad, start with a secured credit card. Now, what is a credit card? A credit card is basically short-term money from the bank. You use it. Then you pay it back. And if you use it correctly, it can help you build credit, earn rewards, protect yourself from fraud, and prepare you for bigger approvals later. But if you use it wrong, it can destroy your score, bury you in interest, and turn a $200 purchase into a 3-year mistake. Why do you need a credit card? Because credit is the language banks speak. When you want a car, they check your credit. When you want a home, they check your credit. When you want funding, they check your credit. When you want a better interest rate, they check your credit. So if you do not understand credit cards, you are missing one of the easiest ways to build credit history. But here is the part most people get wrong. A credit card limit is not your money. If the bank gives you a $1,000 limit, that does not mean you have $1,000. That means the bank is willing to let you borrow $1,000. There is a big difference. This is why people get trapped. They get a credit card, they feel rich, they swipe it, they make minimum payments. Then the balance grows. Then utilization goes up. Then the score drops. Then they wonder why they got denied for a car loan. That is not the bank hating you. That is the credit report telling on you. How do you use a credit card? Simple, use it for things you were already going to buy. Gas, groceries, bills, small expenses. Then pay it back on time and in full. Every single month. Never carry a balance just to build credit. That is one of the biggest lies people believe. You do not need to pay interest to build credit. You need on-time payments, low utilization, and clean reporting. That is the game. And if your credit is bad, do not start by applying for premium cards you cannot qualify for. Start with a secured card. Put down a small deposit. Use the card correctly. Keep the balance low. Pay it on time. Let the bank see that you can manage credit responsibly. Now here is where credit repair becomes important. If your report has collections, charge-offs, late payments, repos, or too many hard inquiries, you may not qualify for good credit cards. Or, if you do qualify, the terms may be terrible. Low limit, high APR, no rewards, no real benefit. That is why before applying for better cards, you need to clean the report. Collections need to be reviewed. Charge-offs need to be checked for reporting errors. Hard inquiries that were not authorized need to be disputed. Late payments that are reporting incorrectly need to be challenged. Wrong personal information needs to be cleaned up, because the better your credit file looks, the better options you can unlock. And here is the surprising part. Your credit score does not just decide if you get approved. It decides how expensive your approval is. 2 people can apply for the same mortgage, same house, same loan amount, same bank. But one person has a 660 score and the other has a 760 score. That small difference can cost tens of thousands of dollars in interest over time. That is why credit repair is not just about a number. It is about money. It is about keeping more of your money instead of giving it to the bank. Account number 3, a credit builder account. Now, this is the account a lot of people with bad credit need to understand, because sometimes your credit report is not just damaged. Sometimes it is also thin. That means you do not have enough positive accounts reporting. So even if you remove negative items, you still need good accounts helping your score. A credit builder account can help with that. What is it? It is usually a small installment account designed to report positive payment history to the credit bureaus. You make payments. Those payments get reported. And over time, it can help show lenders that you know how to handle debt responsibly. Now, why do you need it? Because credit mix matters. Credit cards are revolving credit. Auto loans, personal loans, and credit builder loans are installment credit. Banks like to see that you can manage different types of credit. But listen carefully. Do not go get a loan just to look good. Do not borrow money you do not need. Do not take a high-interest loan thinking it will magically fix your credit. That is not smart. The goal is to build credit without creating a bigger financial problem. How do you use it? Use a small credit builder account only if it fits your budget. Make every payment on time. Set up autopay. Keep the account positive. Then let the reporting work. But here is the mistake to avoid. Do not open too many accounts at once. Do not keep applying everywhere. Do not stack hard inquiries. Because if your report already has negatives and then you add 10 new inquiries, the bank sees risk. It looks desperate. And desperate credit files get expensive approvals. So if you already have hard inquiries, collections, charge-offs, and late payments, fix the damage first. Then add positive accounts strategically, not emotionally. Because credit repair is not just removing negative items. It is also building the right positive history after the damage is cleaned up. Account number 4, a retirement account. This could be a 401k, 403b, or another employer-sponsored retirement account. Now I know what some people are thinking. Marcus, what does retirement have to do with credit repair? A lot. Because banks do not just care about your credit score. They care about your whole financial profile, your income, your savings, your assets, your debt, your payment history, your stability. If you want better approvals in the future, you need to start looking stable on paper. And retirement accounts help build long-term wealth. What is a retirement account? It is an account through your job where you can put money away for your future. Sometimes your employer gives you a match. And if your employer gives you a match and you are not taking it, you are leaving free money on the table. That is not a strategy. That is you donating your future back to HR. Why do you need it? Because getting rich is not just about getting approved for cars and credit cards. It is about building assets. A good credit score helps you access better money, but assets help you keep money. That is the difference. Credit gets you access. Assets build freedom. How do you use it? Start small. Get the employer match if you can, increase contributions over time, and make sure the money is actually invested. A lot of people put money into a retirement account and think the job is done. No, sometimes the money is just sitting there until you choose the investment. That is like buying a car and never putting gas in it. The account exists, but it is not doing what it should be doing. Mistakes to avoid? Do not borrow from your retirement just to buy things that lose value. Do not cash it out for a car. Do not destroy future you because present you wants a better looking lifestyle. And if your credit is damaged, do not use retirement money to hide a credit problem. Fix the credit problem. If you have inaccurate collections, dispute them. If you have charge-offs reporting wrong, challenge them. If you have late payments that are incorrect, get them reviewed. If you have high credit card balances, build a plan to pay them down. Because if you clean the report and build assets, now you are not just chasing approvals. You are becoming the kind of person banks want to approve. Account number 5, a business bank account. This is the account most people ignore until they need funding. And then it is too late. What is a business bank account? It is a separate account for your business income and business expenses, not your personal cash app, not your personal checking account, not money mixed together like financial soup. A real business bank account. Why do you need it? Because if you want business funding, you need to start looking like a business. Banks and lenders want to see deposits. They want to see activity. They want to see cash flow. They want to see that your business is real. And if your personal credit is not perfect, having strong business banking activity can become even more important. Now let me be clear. Business banking does not erase bad personal credit. If your personal credit report has collections, charge-offs, late payments, repos, and hard inquiries, a lender may still look at that, especially for newer businesses. That is why credit repair still matters. But a business bank account helps you organize your money, track income, build credibility, and prepare for funding opportunities. How do you use it? Keep business money separate. Run business income through the account. Pay business expenses from the account. Keep records clean. Do not overdraft the account. Do not make your business look unstable. Because when it is time to apply for funding, you do not want to start building proof. You want to already have proof. Now, mistakes to avoid. Do not wait until you need money to open the account. Do not mix personal and business spending. Do not treat business credit like free money. And do not apply for business funding with a destroyed personal credit file if the lender is going to check personal credit. Fix the report first. Remove inaccurate negative items. Clean up old addresses. Review collections and charge-offs. Dispute unauthorized hard inquiries. Lower utilization. Then apply when your profile looks stronger. Because funding is not just about wanting money. It is about looking fundable. Account number 6, a brokerage account. What is it? It is an account where you can invest your money. Stocks, index funds, ETFs, long-term investments. Now, this is not where you gamble. This is not where you chase hot stocks. This is not where you download a flashy app and start pressing buttons because the chart moved. That is not investing. That is financial entertainment. A brokerage account is for building long-term wealth. Why do you need it? Because after you have emergency savings, after you are using credit correctly, after you are fixing your credit, after you are building positive accounts, after you are contributing to retirement, you need a place for extra money to grow. This is where a brokerage account comes in. It gives you flexibility. No retirement age rules like some retirement accounts. No employer required. No special job needed. Just your money invested for the long term. How do you use it? Keep it boring. Automatic deposits. Low-cost broad market investments. Long-term mindset. Do not check it every 10 minutes. Do not panic every time the market drops. Do not treat investing like a casino. Because the boring strategy is usually the one that actually builds wealth. Now, here is the credit repair connection. If your credit is damaged, high interest debt can destroy your ability to invest. Think about it. If you are paying 25% interest on credit card debt, it is very hard to build wealth at the same time. If your auto loan is expensive because your credit score was low, that payment is stealing money you could have invested. If your mortgage rate is higher because your credit was weak, that extra interest is money that could have gone into your future. This is why credit repair matters. It is not just about getting approved. It is about freeing up money. Better credit can mean better rates. Better rates can mean lower payments. Lower payments can mean more money left to save and invest. And more money invested over time can change your life. So do not look at credit repair like it is just removing collections. Look at it like removing financial weight. Every inaccurate collection that gets removed, every charge-off that gets corrected, every unauthorized inquiry that comes off, every late payment that gets fixed, every balance that gets lowered, that can move you closer to better approvals, lower interest, and more financial options. Now let's put all 6 accounts together. Number 1, a high-yield savings account. That protects you from emergencies so you do not miss payments and damage your credit. Number 2, a credit card or secured credit card. That helps you build credit when you use it correctly. Number 3, a credit builder account. That can help add positive payment history if your file is thin. Number 4, a retirement account. That helps you build long-term wealth and show financial stability. Number 5, a business bank account. That helps you prepare for business funding and separates your personal and business money. Number 6, a brokerage account. That helps your extra money grow long-term. But here is the part most people miss. These accounts work best when your credit report is not fighting against you. Because you can open accounts, you can save money, you can invest, you can apply for cards, you can chase funding. But if your report is full of collections, charge-offs, late payments, hard inquiries, high balances, and wrong information, the banks are going to treat you like risk. And risk is expensive. Risk gets higher interest. Risk gets lower limits. Risk gets bigger down payments. Risk gets denied. So before you go apply for your next credit card, before you try to finance your dream car, Before you apply for a home, before you chase business funding, look at your credit report. Pull Experian, pull TransUnion, pull Equifax. Find out what is hurting you. Collections, charge-offs, late payments, repos, hard inquiries. High utilization, wrong personal information, duplicate accounts, wrong balances. Then build the plan. If it is inaccurate, outdated, duplicated, unverifiable, or unauthorized, work on getting it removed or corrected. If your balances are too high, lower them. If your payment history is weak, start building new positive history. If your file is thin, add the right accounts. If you keep getting denied, stop applying blindly and fix the reason first. Because the goal is not just to have accounts. The goal is to have accounts that work for you. A savings account protects you. A credit card builds you. A credit builder account rebuilds you. A retirement account grows you. A business bank account prepares you. A brokerage account frees you. But a damaged credit report can slow all of it down. So if your credit is the reason you keep getting denied, if your credit is the reason your car payment is too high, if your credit is the reason you cannot get approved for a home, if your credit is the reason banks keep offering you bad terms, then do not ignore the problem. Fix the credit first. Because better credit can unlock better approvals. Better approvals can unlock better cars, better homes, better funding, and better financial options. And that is how you stop letting banks get rich off your mistakes and start making your money work for you.